What is the single most important thing that you need to make your retirement wildly successful? Is it a tax plan that minimizes your future retirement tax liability? Is it an income plan that perfectly fits your spending aspirations for your retirement? Or maybe it has something to do with your investment plan to gain the most out of the investments you already have. Well, in my opinion, it's actually none of these. These are all important parts of your retirement plan, but there's something that's much more important in retirement, and that's peace of mind. Let me show you what I mean. For those that frequently watch the Safeguard Wealth Management YouTube channel, you know that I'm a numbers guy. I believe the black and white numbers of retirement are extremely important. With every decision that we make, with every strategy that we implement, we should have a reason that's backed up by data for why we're making that given decision. And the numbers are incredibly important in retirement, but retirement isn't just a numbers event, it's also a life event. Now, I want to share with you a quote that really resonates with me, and I'm hoping it resonates with you as well. And it's from a very successful investor named Naval Ravikant. And he says, retirement starts when you stop sacrificing today for an imaginary tomorrow. Now, I think there's a very important message in this quote. Many of us have constantly been sacrificing for tomorrow. For instance, when we were working, many of us were raising families. And while we were raising families, we're constantly making sacrifices ourselves so that our children can have a better tomorrow. In terms of working, the whole idea of working and saving for retirement is this idea of sacrificing today for a better tomorrow. Let's say that somebody is earning $150,000 from their job and they're saving for retirement. Well, by definition, if they're saving for retirement, they're living below their means. A portion of that is going to taxes, okay? We never see that money. But then a portion of that we're saving within our 401k, within our Roth IRA. And so we're squirreling money away so that at some point down the road, we can have this idea of retirement. We can have a better tomorrow as we enter into retirement and stop working. But at some point, this dynamic needs to switch. Retirement was our better tomorrow. And if you're retired or moving into retirement, you are here. You are in your tomorrow that you've been sacrificing for. There are certain decisions in retirement that when we look at on paper from a numbers perspective, they don't make the most sense. But when we look at them from a peace of mind perspective, all of a sudden we have a completely different perspective. Let me give you a few examples of what I mean. Let's say that we are thinking about a Roth conversion, and on paper, the numbers don't exactly make sense. For instance, we know that a Roth conversion only makes sense if you are paying a lower tax rate today than you will see in the future. Well, simplistically, let's say that you're performing a $100,000 Roth conversion, and your effective tax rate on that Roth conversion today would be 25%. But on paper, we see that we estimate that your future tax rate on that $100,000, if you withdrew it without the Roth conversion, would be at 23%. Well, on paper, this wouldn't make sense to perform that Roth conversion. You're paying 25% to avoid 23% at some point in the future. Over the next 20 years, growing that $100,000 at a 7% growth rate, that Roth conversion would cost you $8,000 more in taxes. But let's say that you're someone who looks at the national debt and looks at some of the moves that Congress is making, and you're constantly worried about Congress jacking up taxes later into retirement. But performing that conversion protects you from any tax hikes down the road, and more importantly, protects you from worrying about those given tax hikes. Let's take another example. Right now, holding cash seems like an absolute terrible decision. Right now, the highest savings accounts are earning something like 3.25%, and inflation over the last 12 months has been 8.5%. So why the heck would anybody hold cash right now when they are losing significantly to inflation? Well, cash may have a much higher return on investment if it gives you a level of peace of mind. So for instance, let's say that somebody is holding a cash buffer so that if their growth portfolio, their stock portfolio is having a little bit of volatility, they know that they have an income buffer where they can pull from that cash for a few months, a few years, and allow for that stock portfolio to recover. And in reality, from a numbers standpoint, this can actually deliver better outcomes in certain instances. So let's say that somebody's holding a smaller amount of cash in their portfolio that's allowing them to invest a little bit more growth-oriented with the rest of their portfolio, instead of watering down their portfolio with adding a little bit more into bonds, having more of what's called a balanced portfolio. Well, going back to the 70s, the cash and growth portfolio actually did quite a bit better than the so-called balanced portfolio. And so even though cash might look dumb on paper, if it gives you an extra level of peace of mind, cash can actually have a much higher ROI than its pure savings rate. Another classic example is the decision-making process between taking out a mortgage to pay for a new home or paying off that home through savings that you already have. Now, when mortgage rates were down in the 3% range, beating your mortgage rate by investing those savings over a 15 to 30-year time horizon seemed like a very easy decision. But if you absolutely hate debt and carrying a mortgage would take up some brain space and sacrifice some of that peace of mind, I would make the case that that mortgage is costing you much more than 3% on an ongoing basis. Now, this shouldn't be taken to an extreme. It doesn't make sense to hold all of your assets in cash. It also wouldn't make sense to convert at a rate of 35% in order to save at a rate of 15% later in retirement. That gets to a point where the peace of mind ROI no longer starts to make sense. And so there is a gray area in here where we need to navigate. We need to understand that we're not robots, we're not computers. We have ideas and emotions about money that have to be factored into this decision-making process. And in my opinion, this is one of the most important benefits of a good financial planner. They can take your ideas and emotions around money and help you weigh the benefits and drawbacks of every decision to help you navigate this gray area. The ability to navigate this gray area will help you build your best retirement and help you avoid something that we call the cycle of worry. Here's what the cycle of worry is. Well, invariably in this fast-paced world, there's always a breaking news story, and there have been a lot of notable breaking news stories in the last couple of years. So COVID was a big one, and wondering what COVID would do not only to the economy, but also to everyone's health, and how to basically navigate that crisis. We've also had a fast-growing national debt. We've seen very high inflation over the last couple months and years. As of recently, we've seen a lot of market volatility due to the Russian invasion of Ukraine. And so anytime we see one of these basic news stories, invariably it leads us to asking a lot of what ifs. We're seeing a skyrocketing national debt. How might that affect taxes in the future? And how might that translate to my retirement plan? If Russia were to invade another country, could that shake financial markets across the world even more? And could that put my retirement savings in jeopardy? Every time we see one of these breaking news stories, we constantly are asking what ifs. And unfortunately, this worrying and these what ifs can start to infect the other areas of our life, some of the most important parts of our life. For instance, let's say that we're fishing with our granddaughter, and rather than being present in the moment and fishing with our granddaughter, we're worried about the latest breaking news story and what that might do to our retirement. Or maybe we're spending quality time with our grandson, and rather than being in the moment, we're worried about these other what ifs. And when we don't have an answer to one of these what ifs, we face an unknown. And neuroscientists have shown that when we face an unknown, our brain creates more anxiety, more fear because of this given unknown. Now, note that this is irrational. The definition of an unknown means that we don't know whether this outcome is good or whether this outcome is bad. But yet our brain treats these unknowns as if they're a bad thing. When faced with one of these what ifs that we don't immediately have an answer to, our brain typically goes to the worst case scenario. And then whether we make a change or not, oftentimes what happens is this cycle of worry restarts with the next big breaking news story. And with this goal of maximizing peace of mind, it's very important to understand that every what if that we have can be stress tested within our plan. So for instance, let's say you're worried about higher inflation. Well, let's jack up the inflation rate within your plan and see how your plan handles that higher inflation. Let's say that you're worried about this growing debt that we have at a national level, and you're worried about taxes rising in the future. Well, let's raise taxes in the future and see what it does to your plan. See what different decisions you should be making today. Let's say you're worried about Social Security going bankrupt. Okay, let's make a cut to your Social Security benefit and see how your plan stands up. So now you're taking this what if, you're taking the unknown, and you're now gaining some clarity. Finally, with this goal of gaining peace of mind in retirement, make sure you don't get caught up in living out somebody else's vision of your retirement. Traditional planning is absolutely broken on this front. Now, traditional planning will oftentimes take an income goal of, let's say, $75,000. And it will take that income goal and how many years this person is going to spend in retirement and simply statically increase that for inflation moving through time. And so let's say we uploaded this into some planning software and we found that this person had a 76% probability of success. So they have a 1 in 4 chance of not meeting their goals. Well, this can be very alarming. So now this person is thinking, do I need to work longer? Or maybe should I cut my income goal down so that I have a higher probability of success? The last thing this person is thinking about is peace of mind. But we know that traditional planning is almost entirely wrong on this point. Retirement spending doesn't follow a static path. Oftentimes we see that it follows more of a smile. So when we rework this person's plan to follow that idea of a retirement spending smile, we can see that this person can spend quite a bit more in the early decade of their retirement because they expect to see a drop in that middle and late decade of their retirement. And so we build a plan to match this. And because of these adjustments, we can see that this person can retire on the timeline that they want. They can actually spend more in the first decade of their retirement, and they actually have a higher probability of success because of it. Now, in everyone's situation, your plan to meet your goals is going to look quite a bit different. But making sure that you have the peace of mind and confidence to follow through with those goals, I think, is one of the most important things that you can be equipped with moving into retirement to allow you to get the most out of your retirement. And we believe this comes back to building a better plan. I hope you enjoyed this video and a slightly different perspective on what should be your number one goal in retirement. If you want to learn a little bit more on how to unlock increased spending earlier in retirement, click on this video right here. For those wanting to get more out of the first decade and remaining decades of their retirement, I think this video is going to be eye-opening for you. Again, click on this video right here, and always remember, you don't need more money, you need a better plan. Thanks for watching.